Okay, so we are talking about specified audit procedures before we went off. So specified audit procedures to address the RMN. For non-significant components, one of the audit procedures that is highly recommended is analytical procedures. Analytical procedures. I've always mentioned that please don't go into the exam forgetting those 7 audit procedures. Please don't do that. Don't do that. It's called to audit. If the group auditor does not consider that sufficient appropriate evidence will be obtained from the sum of the above work, then additional work should be performed on non-significant components. Basically, what it's saying is that the group auditor considers what are the best audit procedures. And so if the group auditor feels like analytical procedures does not necessarily capture the essence of the audit work at a group level, then additional work or additional procedures must be applied. Communication with component auditors. We've said that communication is very, very communication with component auditors is very, very important. Communication with component auditors is very, very important. If there's not effective communication between the group auditor and the component auditor, there's a risk that the group auditor may not obtain sufficient appropriate audit evidence on which to base the group audit opinion. So there has to be an effective communication between these two parties. It is therefore vital that there's clear and timely communication between the group auditor and the component auditor. The group auditor's requirements are usually communicated in a letter of instruction. So for those who have experience in audit and are working either as component auditors or group auditors, you'd see you see what we call this letter of instruction that is talking about, which will have the group auditor's requirements, the requirements for the audit. The component auditor's communication with the group auditor will usually be in the form of a memo or report of work performed. However, such communications may not necessarily be in writing. You see, such communications may not necessarily be in writing. For example, so there's a good example here. The group engagement team may visit the component auditor to discuss, identify significant risk, or review relevant parts of the component auditor's documentation. But in such cases, you have to document. Anyways, must be properly documented. So for those in audit who work as either component auditors, they will see that sometimes the group audit team would fly if the component audit team is in Ghana. The group audit team will fly from wherever, and they'll come and have a conversation with the component auditor to identify significant risk. In cooperating with the group auditor, the component auditor will provide the group engagement team with access to relevant audit documentation, provided this is not prohibited by law or by regulation. So this part of the slide is just showing us how this communication is done. So what is contained in the group auditor's letter of instruction? What is what is in the group auditor's letter of instruction, right? Number one is the work required. What is the kind of work that is required? That's what we need to understand. The components auditor must understand what is the work required and what is the use to be made of that work. What is the use to be made of that work? And the form and content of the component auditors' communication with the group engagement team. So we need to set out the communication parameters right from the beginning. What will be the form and what will be the content of the communication with the group engagement team. Right. Some matters that will be discussed as well is, ethical requirements, component materiality, risk, and a list of related known parties. So these are all things that the group audit requirements will capture, or the group letter of instruction will capture. Now, the component auditor's report of work performed should include. Now, after the component auditor has done their side of the work, their report should include things like compliance with ethical requirements, identification of the financial information on which the component auditor is reporting, any instances on non-compliance with the laws and regulations. Are there any list of uncorrected misstatements? And the component auditor also needs to identify what the overall conclusions were. It's just like you are basically doing an audit, The things that would be in your report, so this is a report to group. Statement of compliance. We complied with group audit requirements. We complied with ethical requirements as well. You talk about your findings, your conclusions. You talk about whether you identified any material weaknesses in internal control. All of that. Basically like how an audit is set up. Any questions? Okay, now let's talk about involvement of the group auditor in the work performed by the component auditors. Involvement of the group auditor in the work performed by the component auditors. Now, it is the group auditor's responsibility to decide what work is to be performed on the financial information of the components. So like we said, we will see this in the group audit requirements, right? The group auditor then has to decide the extent of his involvement in that work. But the group auditor would be involved in the work of the component auditor. For significant components, he must, as a minimum, discuss with component management or the component auditor the business activities of the components that are significant to the group. It's very, very key. You must discuss as a minimum, discuss with component management. Discuss with component management or the component auditor the business activities of that component. So what are the business activities of that component? It's very key. Another thing that we cannot lose sight of is the risk of material misstatements. He needs to have a discussion on that. Risk. Please don't forget that. If you forget anything, you see that risk is appearing here countless times. Where significant risk of material misstatements of the group financial statements have been identified at a component, the group auditor should evaluate the further audit procedures to be performed to address such risk and consider whether it is necessary to be involved in those procedures. Where significant risk of material misstatements, let me repeat that again, of the group financial statements have been identified at a component, the group auditor should evaluate the further audit procedures to be performed, right? And consider whether it is necessary to be involved in those procedures. So the group auditor has, a lot of responsibility. They will determine whether the audit procedures to be performed to address the risk, right? When you identify a risk, then you have to find a way of mitigating it. Not mitigating it, but find a way of addressing that risk. So they need to evaluate the audit procedures to address such risk and whether it is necessary to be involved in such procedures. So when we talk about involving yourself in the work performed by component auditors, what does it mean, Craig? Involving yourself in the work of component auditors, what does it mean? It means meetings. Meeting with them. You meet with them. So for those who have, again, if you've had the privilege of being a component auditor, you would have meetings with the group auditor. So basically want to understand the components. Another thing is reviewing the component auditor's overall strategy and plan. Another thing is that you perform risk assessment procedures at the component level. Perform risk assessment procedures. Again, you see risk here again. And then you design and perform further audit procedures. So this is what we mean by involvement. At least if you don't remember anything, remember meeting. Remember meeting, remember risk, performing risk assessment procedures. Any questions before we move to joint auditors?
So I have a question.
Okay.
With the component auditors, per what I've learned so far, it's as if anything they do, it's upon the direction of the group auditors. Okay, so I wanted to find out if, like, it means that those subsidiaries, they don't audit on their own. They don't audit on their own, but it is through the group audit that they direct the component auditors to do this and do that. I wanted to get clarified.
Sorry, when you say they don't audit on their own, what do you mean?
I mean, like, you see, since it's a subsidiary, let's say in Ghana, and then the year has ended, they've prepared individual financial statement for that particular subsidiary, right? Like, normally, since probably it's a listed company, it would also be audited on its own for its own, like, this thing. I was trying to see that, I was trying to know, or I'm trying to inquire that if it's a subsidiary to a parent company somewhere, what I know about what I've learned right so far is saying that in relation to group audits, it is the group auditor who would direct the component auditors to do this, that in relation to group auditing. So is it that they don't perform individual audits on the subsidiary, or like they just follow the instructions of the group audit?
Oh, okay. I see what you mean. Yeah, so there are times when what do you call it? There are times where the subsidiary will be listed or not listed, depending on the type of company it is. They will be audited, right? They will be audited. So your question is, I think your question is, if they are audited, why does the group auditor need to give them instructions and all that on what to do, right? Is it something like that?
Yes, please. Yes, please.
Okay, so Yeah, so the reason is that how do I even explain it? Let me use a simple example. When you are let me see. I'm trying to give a good example, like use a life example. When you're auditing a component, when you're auditing a subsidiary as an individual, as an individual component, it's totally different when you're auditing a group, right? And when you're auditing a group, there's usually what we call a group audit strategy, right? So the group audit strategy, as we've already indicated, would have some requirements, on areas to focus on, markets to focus on, the usual risk within certain markets. So for example, if it's Vodafone has Vodafone in Madagascar, they know the kind of environment that pertains in Madagascar and what kind of things go there. So the group auditor would want the component auditor to approach the audit in a certain way to achieve the overall group audit results, right? And they do this in collaboration with the component auditor, because the component auditor, they are kind of like on the ground. So to answer your question, yeah, even though they might have, even though there might be an individual audit, right, by the component auditor already, what the group audit does is, because the group audit is looking at the overall picture, it brings some guidelines, it influences, the component auditor and how it does its work in order to suit the overall group objectives. In order to suit the overall group objectives. And it's not like individual audits, or if you're auditing a subsidiary, is very different from a group audit, right? They kind of like go hand in hand, because any company that's a serious company, which is a group, whilst they'll be thinking of the audit of their individual subsidiaries and the group as well, So they kind of go hand in hand. It's just like, let me use an example. It's just like a church that has many branches, right? A church with many branches. If we go to one church, even though there are guidelines from the top, right? If you go to one church, they have their own way of doing, they have their own unique way of doing stuff, and they've also borrowed certain principles from the headquarters church. So that's how it's something of that nature. I don't know if I answered your question. I'm trying to make it as practical as possible so that doesn't confuse you. If it didn't answer, I can.
Yeah, you've answered my question.
Yeah. So it's just like
you've answered my question. So I want to know.
Sorry, go ahead.
So it means that in that case, in the situation where the subsidiary is a listed company, that means they'll be actually performing two functions apart from performing the individual one. When the group auditors direct them to do this, do that, they'll be doing that in addition to what they do for the individual financial statement.
Yes, and it happens around the same time. It's not like something. Okay, depending on the timetable of the audit, So components, anybody who is like what do you call it? Anybody who's a component auditor understands it. Like, you have two sides to the coin. You are performing an audit of the subsidiary you're looking at, and also you are being influenced by group audit requirements as well.
Okay, thank you very much.
Okay, now let's look at joint auditors.
Yeah, hello, sir.
Yes.
I also have a question.
Okay.
So is it that the component auditor is always the auditor for the individual subsidiary, or there could be a difference? That, for example, if Vodafone Ghana, PwC audits Vodafone Ghana, and then Vodafone UK wants, say, KPMG to be their component auditor, is it possible, or they will have to still take PwC as the component auditor?
Okay, I'll throw this question back to the class. What do you think? What do you think?
Okay, for my own, what I think is that I think they would, it will be more cost effective to use one company, one auditor.
Okay. Anyone has another thought? That's a good question, though.
Well, I think that first of all, they should look at, let's say, if we have KPMG being the group auditor and probably KPMG Ghana being, they want to make KPMG Ghana to be the component auditor. They have to look at certain things, whether they have the staff have the operating skills to undertake the various tasks ahead, on the engagement process. If they realize that they don't have that, then they should then take probably another auditor. Then it would be like, as we discussed earlier on, taking on more or less like from an expert opinion from another auditor on the components. So it basically depends on the task ahead or the engagement, whether they have the right requisite skills and the skills to undertake the engagements and so on. Yeah.
Okay, so, I never, I don't know if it's this class, but I mentioned that there's maybe it's not this class. There's a reason why multinationals, right, or group companies, when they are selecting auditors, they go for big four companies. And this is one of the reasons, right? They go for big four companies because, I think, is this the class? Can't remember. Because just imagine, right? If let's say, in the UK, there are local audit firms, right? I'm a group company. I'm like Vodafone. There's a local audit firm, maybe Wayne and Robertson Associates, somewhere in Birmingham. Okay. And Vodafone decides that, oh, these are the people who are going to audit us. Now, how would they perform their group audit? Just think about it. When they go to Ghana or when they go to South Africa, are they going to be selecting auditors by heart in every nation? So you see, practically, it doesn't make sense. So and that's why these companies, these top companies who have subsidiaries listed all over the world, they would go for these big four companies. And also, they need to check, right, whether so the subsidiary reasons that Caleb was given, whether you have the requisite competence, you have the time, the people even have the time to do that and all that. But what happens in practice is that, I haven't yet seen a situation. It's possible, but personally, I haven't seen a situation where PwC has, I think it might be there, but I haven't seen it yet. Yeah. Because practically what happens is that if PwC is auditing Vodafone in the UK, they will allow for PwC Ghana, as far as they have the competence and experience to audit Vodafone and to help them with the component audits of Vodafone in Ghana. So I don't know if I answered the question on that.
Yes, sir. Thank
you. Yeah. Okay. A joint audit involves two or more audit firms being appointed to the audit to audit the financial statements of an entity. The joint audit provides a joint opinion on the financial statements. Joint audits may occur in other situations, but they are commonly found in group audits. So like what we are discussing earlier, right? Okay, let me just go on. In particular, when a group acquires a new subsidiary, it is not unusual to appoint the group's auditors jointly with the subsidiary's existing auditors. So this is a case where, let's say Vodafone acquires, let's say for some reason Vodafone acquires Glo in Nigeria, and Glo has their own auditor. What happens usually is that once you've acquired a company, you adopt their auditors. So this is also a situation. There are several situations that happen that creates a situation where the group auditor will be different from the component auditor. There are several situations like that. So a joint audit is where two or more audit firms being appointed to audit the financial statements of an entity. Additionally, in some countries, joint audits are mandatory in certain situations. For example, for audit of listed companies, which produce consolidated financial statements in France. So in France, there are requirements like that, where joint audits are mandatory. This practice is thought to increase competition between audit firms and reduce the dominance of the Big Four. So you see what exactly I was saying. I was saying that there's a reason why these group companies, they choose the Big Four, because it's easy, and so it increases the dominance of the Big Four naturally. So they'll be all over the world because it's easy if they have partnerships all over the world. It's easy to adopt them as your auditor, and you really have to go through the stress of finding auditors in every country. So the practice is thought to increase competition between audit firms and reduce the dominance of Big Four. Joint audit should not be confused with shared audit. So when we say joint audit, it's not shared. So what's the difference here? While shared audits also involve more than one auditor, the overall responsibility for signing the shared audit report lies with a single firm. Joint audit requires the signature of multiple firms. So that's the difference. See, that's the difference. That's the difference. I hope that's clear.
Yes, sir.
Yeah, okay. Advantages of joint audits. Anytime I feel like we would get ahead, I don't know. The reasons why joint auditors might be appointed include the following issues. Number one, the client's company may be so large that it requires the services of more than one firm of auditors. So there are situations. So I would love for you guys to investigate. I think there are situations like that, just I can't remember them. As you go through, if you find them, you can just message me. I'd love to, like a practical example, not like a book. The client's company may be so large that it requires the services of more than one firm of auditors. So that's a reason. After the acquisition of a large subsidiary, using joint auditors may help the transition process. Using joint auditors may help the transition process while the group auditors become familiar with the new subsidiary. So you use the joint auditors to help in your transition process. Joint auditors may also provide a higher level of technical expertise than, they say, two heads are better than one. So if you do joint audits, you get more technical expertise to bear. Another thing is improved geographical coverage may be obtained for the audit, where each of the joint auditors on its own does not have offices that cover all the geographical locations of the component companies in the group. Now, what are the disadvantages of joint audits? Number one, extra cost to the client. Number two, possible inconsistencies between the two auditors. Number three, just like all the problems that happen when two people are supposed to work together on something. The possible difficulty the two firms may have in agreeing the division of work. A whole lot of issues. The two firms may find it difficult to work together. If there's a claim of negligence, who do you hold responsible, accountable? All these are disadvantages. Performing joint audits. The key to a successful joint audit is good communication between firms, including joint planning meetings and regular discussions between the firms at all key stages of the audit process. Audit firms performing joint audits will have a number of factors to consider, including the following. Number one, each audit firm will need to consider if the other firm is independent. So independence and competence. And that's what I think Caleb mentioned. You need to confirm competence. The two audit firms will need to agree on a joint audit strategy. So if you are not working well together, it creates a lot of problems. They need to also agree on how to coordinate their work. It's also not likely. What happens is that the audit firms would like to review each other's work. They would like to review each other's work as they are both responsible for the audit opinion. Yeah. Now, what is the role of the group auditor with regard to consolidation? As discussed above, IC 600 requires the group auditor to obtain an understanding of the consolidation process. We've talked about understanding. Very, very important when it comes to group audits. And this understanding will help us to assess the risk involved in the consolidation process. The group auditor will want to confirm that the following actions have been taken correctly by the client group. And some of the things that there has been accurate information transfer from the individual financial statements of the components of the group to the final consolidated financial statements. I hope that is clear. The individual, one of us was asking us a very good question, where the component auditor would have prepared the individual financial statements. Now, the whole thing about group is about consolidation. So there has to be an accurate transfer of information from the individual financial statements to the consolidated financial statements. And the group auditor will also confirm that appropriate consolidation adjustments have been made. In the beginning, we talked about things like currency differences and all that. Okay, let's talk about documentation and communication with management and those charged with governance. In addition to the meeting requirements of ISA 230, audit documentation, the group auditor must also document the following matters. Of course, if you're a group auditor, you have to document stuff about your components. You have to document the type of work performed on these components and you have to document the extent of the group auditor's involvement in the work. You also have to document the written communications. We talked about this, written communications. Written communications. The group auditor should make group group management aware on these matters. You know, these are high risk matters. So when we are talking about material weaknesses, so these are high risk issues. These are high risk issues. Okay, so number one, material weaknesses in the design of group-wide controls. Material weaknesses which are significant to the group that the group auditor has identified at the component level. Material weaknesses which are significant to the group that the component auditors have identified. And issues of fraud. So issues of material weaknesses relating to controls and any issues of fraud. These you have to communicate with group management. Now let's talk about communication with those charged with the governance of the group. Now, what are some of the things you communicate to these people? Again, similar to what we talked about, the type of work to be performed, the group auditors' involvement in the work to be performed by component auditors, any concerns over the quality of any component auditor's work, any limitations on the group audit, right? And if there are any issues of fraud, you also communicate. Oops, what did I do? Okay. Okay. Any questions? Okay, so looks like there are no questions. So we'll move on to audit-related services. Audit-related services. Now, what is the distinction between audits and audit-related services? Audits